First, let's get straight to the sell-off. Joining us now is iCapital Chief Investment Strategist Anastasia Amoroso and Wells Fargo Head of Global Equities and Real Assets Samir Samana. Guys, good afternoon. Anastasia, the lion's share of the S&P's drop today came right after the president's 9:41 a.m. Eastern Post attacking Fed Chief Powell. Some market participants also have been hoping to hear about progress on trade deals. What does today's action, including the weak dollar, higher yields, tell us about investor sentiment?
Right. Well, it's all about uncertainty. And we didn't need any more uncertainty coming in today because everywhere you look, we're in the midst of the earnings season. If what you hear from companies, they don't know how to parse all this tariff uncertainty. So that's the first point. The second point, now we have to be uncertain about the future of the Fed independence. And so that's what the markets are parsing through. Now, I will say, John, that it's not only that, but it's also some international markets are closed today. We're still in the earnings blackout window. And, we also have a bit of a buyer strike going on. So I think it's this combination of low market depth, of low liquidity, and then you've got this amplification of the uncertainty. So that's why you get the price action that's accelerated to the downside at one point. Now, I will say I don't think we quite have to say yet that the Fed is not going to be independent and the Fed chair is going to be fired. But having said that, this standoff between the two might continue.
Okay, Samir, there is a school of thought that there's a balance here for the investor class. Bad news was front-loaded with the tariffs, but good news is around the corner with tax and regulation cuts. How, if at all, should investors factor in also a growth slowdown and the resulting hit to state and local revenue and the working class hardship that could result?
Yeah, great question. So I guess what I would say is, look, in this sea of uncertainty, let's maybe start with where the certainty does lie, right? Is we've had a VIX that's jumped north of 60. We've had, stocks above their 20-day, their 50-day, their 200-day at very low levels. We've had, at one point, a 20% decline, and we have very low levels of sentiment. What history tells us is, look, if you're thinking about, 1 to 3 years out, those tend to be very good buying opportunities. The tricky part is, over the next couple of quarters, we're still going to kind of be working through, to your point, kind of, tariffs and, probably, immigration and what they mean for economic growth. It probably does mean a soft patch. It may also possibly lay the groundwork for one additional rate cut, we believe. And then, probably, starting around October, November, the administration probably pivots to midterms. And I think the market probably at that point bottoms and starts to rally. So, you've got a few months here to kind of take advantage of the weakness, but there's no reason to rush out and buy stocks today.
S&P 500 settling here. It looks like 51.58, 51.50. It's one of those technical levels, I think, because we've been playing with it, testing it. So the fact that we settled above that perhaps may be good from a technical standpoint, something we'll talk about later in the hour as well. But in general, we have every sector in the red today in the S&P, Anastasia. But it is some of those more defensive-leaning sectors that continue to do better, even as we do have dollar down and yields up looking across asset classes. Is that where you want to invest in this market into some of these more defensive areas? And if so, what are we calling safe haven, given some of the activity we are seeing across asset classes?
I guess gold, that's what you call a safe haven. But, I will say for equity investors that have to be in equities, it is all about the defensive sectors. And I don't think it's just about today. It's been about this full year. And, Morgan, you mentioned technicals. Technicals do not really matter at this juncture until you have a positive catalyst emerge. And in fact, if you look at the technicals, you got the 50-day moving average that's below the 200-day moving average. Nothing good typically happens during, with the setup until you have a reversal of the momentum. Now, the thing is, I don't see the trade deals being cut imminently, and the second quarter is likely to be about companies adjusting their supply chains. And one of two things is likely to happen. Either they raise prices, which squeezes consumer wallets, or they readjust their supply chains, and maybe that they shoulder the cost of that, and that means margins get squeezed as well. So that's why it's really difficult to look at the cyclical sectors, and you have to look at sectors that have high domestic exposure in terms of revenues, but also their costs as well. And to your point, when you look at staples, when you look at utilities, when you look at real estate, those stand out as being most defensive from the perspective of that domestic exposure. So I would stick with those as kind of the core part of the equity portfolio. I will say, though, just to agree with Samir here, if you take a step back and if you look at the level of bearish sentiment that we have, these periods of time, I should say, tended to be buying opportunities. So if we're going to muddle through the short-term pain over this coming quarter, you want to take advantage of that with a long-term time horizon if you have cash to deploy in your portfolio.